Dr. Banknote Training.
Welcome to this Know Your Customer, or KYC, training for financial institutions. In today's financial environment, institutions must not only provide services but also protect the financial system from misuse. Criminals often attempt to exploit banks and financial platforms to move illegal funds, commit fraud, or conceal illicit activity. KYC procedures are designed to prevent that. In this training, we will break down what KYC is, why it matters, and how financial institutions apply these processes to verify customer identity, monitor transactions, and manage risk. By the end of this session, you will understand the key elements of effective KYC compliance and how these practices help maintain trust in the global financial system. Let's begin by reviewing the objectives of this training. The goal of this session is to provide a clear understanding of Know Your Customer principles and compliance responsibilities within financial institutions. During this training, you will learn what KYC is and why it plays such a critical role in financial regulation. You will also explore the regulatory expectations that require institutions to verify customer identities and monitor financial activity. In addition, we will discuss practical procedures used to identify customers, assess risk levels, and detect potential signs of financial crime. Ultimately, this training aims to strengthen your ability to support compliance efforts and contribute to a safer and more transparent financial system. So, what exactly is KYC? KYC stands for Know Your Customer, a fundamental compliance process used by financial institutions to verify the identity of their clients. This process ensures that institutions understand who their customers are, the nature of their financial activities, and the level of risk they may present. KYC procedures typically occur when a customer first opens an account, but they also continue throughout the relationship through ongoing monitoring. By verifying identity and assessing potential risk, financial institutions can prevent the misuse of their services and ensure they operate within regulatory requirements. KYC matters because it helps protect both financial institutions and the broader financial system. Without strong verification processes, criminals could easily exploit banks to move illegal funds, disguise illicit transactions, or commit identity fraud. KYC helps prevent these risks by ensuring that financial institutions know who they are doing business with. This process also protects an institution's reputation and ensures compliance with regulatory expectations. When properly implemented, KYC creates a safer financial environment for customers, institutions, and regulators alike. One of the primary goals of KYC procedures is the prevention of financial crime. Financial crimes can take many forms, including money laundering, fraud, terrorist financing, and corruption. Criminals often attempt to move illegal funds through legitimate financial systems in order to make those funds appear lawful. KYC processes help stop these activities by requiring institutions to verify customer identities, understand transaction behavior, and monitor for suspicious activity. By implementing strong KYC procedures, financial institutions act as a critical line of defense against financial crime. KYC is not just a best practice, it is a regulatory requirement. Financial institutions operate under strict regulatory frameworks designed to prevent financial crime and maintain transparency within the financial system. In the United States, this includes regulations such as the Bank Secrecy Act, often called the BSA. Institutions must also comply with anti-money laundering, or AML, obligations, which require monitoring and reporting suspicious activities. Another key requirement is the Customer Identification Program, or CIP, which ensures institutions collect and verify essential identifying information from customers. Understanding these regulatory requirements is essential for maintaining compliance. The Customer Identification Program, commonly known as CIP, is a core component of KYC. CIP requires financial institutions to verify the identity of each customer before opening an account. This process involves collecting identifying information and confirming that the customer is who they claim to be. CIP also requires institutions to maintain records of the identification information collected and the verification methods used. These procedures ensure institutions can demonstrate compliance with regulatory requirements and prevent the use of fake or stolen identities. To perform effective KYC verification, institutions must collect certain essential customer information. This typically includes the customer's full legal name, date of birth, residential address, and identification number. In many cases, institutions may also request information about the customer's source of funds or occupation, particularly when opening accounts with higher risk profiles. Collecting accurate information helps institutions confirm identity and better understand the expected financial activity of the customer. This information forms the foundation of the institution's risk assessment process. After collecting identifying information, the next step is verification. Financial institutions use several methods to confirm a customer's identity. Traditional methods include reviewing government-issued identification documents such as passports or driver's licenses. Many institutions now also use advanced technologies, including biometric verification, facial recognition, and digital identity verification tools. These methods help institutions detect fraudulent identities and ensure that the individual opening the account is legitimate. Effective identity verification significantly reduces the risk of fraud and financial crime. Once identity has been verified, financial institutions perform customer due diligence, often called CDD. CDD involves evaluating the customer's risk level and understanding the nature of their financial activity. Institutions review the information collected during onboarding and assess factors such as occupation, geographic location, and expected transaction behavior. This process helps institutions determine whether a customer presents a low, medium, or high level of risk. Customer due diligence also involves ongoing monitoring of account activity to ensure transactions remain consistent with the customer's profile. For higher-risk customers, institutions must perform enhanced due diligence, also known as ED. ED involves deeper investigation and additional verification procedures. This may include gathering more detailed information about the customer's background, reviewing business relationships, or verifying the source of funds. High-risk customers might include individuals with complex financial structures, politically exposed persons, or clients conducting large international transactions. Enhanced due diligence allows institutions to better understand potential risks and apply stronger monitoring measures when necessary. Modern KYC programs use what is known as a risk-based approach. This means institutions allocate resources based on the level of risk associated with each customer. Low-risk customers may require standard verification procedures, while higher-risk customers may require additional monitoring and investigation. By prioritizing higher-risk areas, institutions can more effectively detect suspicious activity and manage compliance resources efficiently. A risk-based approach ensures that institutions remain both compliant and operationally effective. Identifying red flags is an essential part of KYC compliance. Red flags are indicators that may suggest suspicious or potentially fraudulent activity. Examples include customers providing inconsistent or incomplete information, unusual transaction patterns, or reluctance to provide required documentation. These warning signs should prompt further investigation and may require additional verification procedures. Recognizing red flags early helps institutions prevent financial crime and maintain regulatory compliance. KYC does not end after onboarding. Financial institutions must continuously monitor customer activity to detect unusual or suspicious behavior. Transaction monitoring systems analyze patterns and flag activity that deviates from a customer's expected behavior. Institutions may also conduct periodic reviews of customer accounts to ensure that information remains accurate and risk levels remain appropriate. If suspicious activity is identified, institutions may be required to report it to regulatory authorities. Continuous monitoring is a critical part of effective KYC compliance. Proper documentation is essential for maintaining KYC compliance. Financial institutions must maintain records of customer identification documents, risk assessments, and transaction histories. These records help demonstrate that the institution has followed regulatory requirements and applied appropriate due diligence procedures. Accurate documentation also supports internal reviews and regulatory examinations. Without proper records, institutions may struggle to prove compliance or detect suspicious activity. Recordkeeping is another critical component of KYC programs. Financial institutions must securely store customer documentation and ensure records are maintained for the required retention period. These records must also remain accessible in case regulators request them during audits or investigations. Effective record-keeping systems help institutions maintain compliance while protecting sensitive customer information. Proper storage and access controls are essential to ensure both security and regulatory adherence. Even well-designed KYC programs can encounter challenges. Common mistakes include collecting incomplete customer information, failing to identify red flags, or maintaining inadequate documentation. These errors can create compliance risks and make it more difficult to detect suspicious activity. To avoid these issues, institutions should ensure staff receive proper training and follow standardized verification procedures. Thorough review processes and strong internal controls can significantly reduce the likelihood of KYC errors. Effective KYC programs rely on strong policies and consistent implementation. Institutions should maintain clear procedures for customer identification, verification, and monitoring. Regular staff training helps ensure employees understand compliance responsibilities and recognize potential risks. Technology can also improve efficiency by automating identity verification, transaction monitoring, and record-keeping. By combining strong policies, skilled staff, and effective technology, institutions can build robust KYC programs that protect both customers and the financial system. Let's consider a real-world example. In this case study, a financial institution identifies suspicious activity linked to a customer account. The institution reviews the customer's profile, transaction history, and supporting documentation to determine whether the activity aligns with the customer's expected behavior. By analyzing the data, investigators can identify potential red flags and determine whether further action is required. Case studies like this help illustrate how KYC procedures work in practice and how institutions respond to potential compliance concerns. To conclude, KYC plays a vital role in protecting the financial system. By verifying customer identities, assessing risk, and monitoring transactions, financial institutions can prevent financial crime and maintain regulatory compliance. Strong KYC programs also protect institutional reputation and help build trust with customers and regulators. Effective compliance requires vigilance, accurate documentation, and a commitment to following established procedures. When implemented correctly, KYC serves as a powerful tool for maintaining transparency and integrity within the financial system.